Here's a summary of the Nike Q1 FY2026 earnings call, designed for clear and concise delivery. Introduction. Good afternoon, everyone, and thank you for joining today to discuss Nike Incorporated's first quarter fiscal 2026 results. Leading today's call are Nike Incorporated President and CEO Elliott Hill and EVP and CFO Matt Friend. CEO Elliott Hill's key messages. Elliott Hill emphasized that Nike's journey back to greatness has just begun, highlighting tangible progress made over the past 11 months driven by Win Now actions. This quarter, these actions delivered momentum in key areas: running, North America, and wholesale partners. Consumers are responding, and Nike is achieving early wins. A significant strategic shift is the new sport offense, which realigns the organization by sport across Nike, Jordan, and Converse brands. This aims to create more nimble, focused teams, leading to sharper consumer insights, innovation, and more meaningful connections with sport communities. The refresh of the House of Innovation in New York by Sport, for example, has already led to double-digit revenue increases. Mr. Hill cited running as a strong proof point, with the business growing over 20% this quarter, demonstrating the effectiveness of focusing on athlete needs and delivering consistent innovation. This sport offense approach is being applied to other key areas like global football, which is preparing for the 2026 World Cup, and new market opportunities such as Nike ACG and a partnership with Schemes. However, Mr. Hill acknowledged that sportswear teams have significant work to do, with the business continuing to decline. While classic franchises like Air Force One are stabilizing and Air Jordan 1 inventory is improving, the Dunk is being managed down, and Converse is undergoing a global market reset with new leadership. North America showed positive steps with over 1,300 running spaces reset and a successful launch on Amazon. However, Greater China remains a challenge, with revenue down 10% due to structural issues and underperforming seasonal sell-through, requiring larger investments to maintain marketplace cleanliness. Nike's commitment to China remains strong, with a focus on leading with sport and refreshing retail environments. Globally, Nike Digital is still finding its footing as the company strategically reduces reliance on classic franchises and pulls back on promotions for long-term brand health. Mr. Hill cautioned that progress will not be perfectly linear, acknowledging challenges like a cautious consumer, tariff uncertainty, and the ongoing realignment. CFO Matt Friend's key financial metrics and guidance. Matt Friend began by stating that Q1 revenues were up 1% on a reported basis, but down 1% on a currency-neutral basis. Nike Direct declined 5%, with Nike Digital down 12%. Wholesale grew 5%. Gross margins declined 320 basis points to 42.2%. This was primarily due to higher wholesale and factory store discounts, increased product costs including new tariffs, and unfavorable channel mix. SG&A expenses were down 1% year-over-year, reflecting lower brand marketing compared to prior year key sport moment investments, partially offset by higher sports marketing expenses. Operating overhead was flat. Earnings per share for the quarter were 49 cents. Inventory decreased 2% year-over-year, indicating progress towards a healthy marketplace. Looking ahead, Mr. Friend provided guidance for Q2. Revenues are expected to be down low single digits, including a 1% benefit from foreign exchange. Gross margins are projected to be down approximately 300 to 375 basis points, with a net headwind of 175 basis points from new incremental tariffs. SG&A dollars are expected to be up high single digits. Other expense net is expected to be an expense of $10 to $20 million. For the full fiscal year 2026, Nike expects wholesale revenue to return to modest growth. Nike Direct not to return to growth this fiscal year as they reposition it as a full-price business. North America to continue leading global recovery, while Greater China and Converse will require more time and will be headwinds. SG&A to grow low single digits. Mr. Friend highlighted that the newly issued tariffs now represent an estimated gross incremental cost of approximately $1.5 billion annualized, up from $1 billion previously. This is expected to increase the net headwind to gross margin in fiscal 2026 from 75 basis points to 120 basis points. Regarding margins for the balance of fiscal 2026, Mr. Friend stated that while benefits from less inventory clearance are expected in the second half, the overall outlook for fiscal year 26 margins has moderated due to new tariff rates and the time needed for mitigation actions to annualize. Longer term, the company still believes double-digit margins are achievable, driven by reigniting organic growth, improving the full-price mix, and leveraging operating scale. Key financial highlights: Q1 FY 2026 revenue, plus 1% reported, minus 1% currency neutral. Nike direct revenue, minus 5%. Nike digital revenue, minus 12%. Wholesale revenue, plus 5%. Gross margin, 42.2%, down 320 bps. Earnings per share, EPS 49 cents. Inventory, minus 2% year-over-year. Future forecasts and guidance, Q2 FY 2026 and FY 2026 outlook. Q2 revenue, down low single digits. Q2 gross margin, down 300 to 375 bps. FY 2026 wholesale revenue, modest growth expected. FY 2026 Nike Direct, no expected return to growth. FY 2026 tariffs impact, $1.5 billion annualized cost, 120 bps headwind to gross margin for FY 26. Significant risk factors, tariff uncertainty. New tariffs are a significant cost headwind, impacting gross margins. Cautious consumer. The macroeconomic environment and consumer spending habits remain a concern. Marketplace challenges, specific regional issues in Greater China, and the ongoing repositioning of Nike Digital present ongoing challenges. Nonlinear progress. Management acknowledges that the turnaround journey will not be smooth or linear. Sportswear decline. The continued decline in sportswear requires significant focus and strategic recalibration. Highlights: running business growth, over 20% growth, demonstrating the success of the sport offense. North America momentum, growth in revenue and key strategic initiatives showing early promise. Wholesale partner strength. Spring order book is up year-over-year, indicating renewed partner confidence. Inventory management, steady progress in reducing inventory levels. Sport offense activation, strategic realignment to focus on sports is underway and shows early positive signs. Lowlights, gross margin decline, driven by discounts, product costs, and tariffs. Nike digital performance, continued decline, with organic traffic slowing. Greater China challenges, revenue decline and structural issues requiring significant investment and time for recovery. Sportswear business decline remains a significant area needing improvement. Increased tariff costs, a substantial and growing financial headwind. Important statements from CEO and CFO. Elliott Hill, CEO. Nike's journey back to greatness has only just begun, and the sport offense is going to be so critical to our success. He stressed the importance of organizing by sport to gain sharper insights and drive innovation. He also highlighted the positive early results in running and North America, while acknowledging the work ahead in sportswear and Greater China. Matt Friend, CFO. We are encouraged by the progress that we have made, as reflected in our results, and yet we still have much work to do. He detailed the financial impacts of the win now actions and the increased tariff costs, outlining the company's outlook for Q2 and the full fiscal year, while emphasizing the long-term belief in achieving double-digit margins. He also noted that the impact of new tariffs is now estimated at $1.5 billion annually. In closing, Elliott reiterated, "We are more confident than ever that our Win Now actions are the right path forward. We are in the early stages, and our comeback will take time. And our progress won't be linear. We're getting back to leveraging Nike, Inc.'s unmatched portfolio of brands, sports, and countries to drive deeper consumer connections and profitable sustainable growth."